Hey folks, welcome back to this edition of Ben's Bits. A few weeks ago we discussed the analogy of a garden and how farmers use planting in a very specific way that allows pollination to be used in the most effective and efficient manner. Oftentimes that makes harvest time much more abundant. The takeaway being that we want to maximize our yield or return in the most efficient way possible because it allows us to grow our portfolio. And if we plan correctly, the investment vehicle of choice will accelerate us towards our goals faster and allowing for more yield or return to take place. And that obviously will in turn allow us to generate more with the same resources we have and make the compounding effect take place. We had a lot of feedback about it, and one of the discussions that resulted from that particular video brings us to today's topic. Now, we've all heard the expression hedging our bets, right? But what does that specifically mean for you, and how would one apply that to your investing habits? Well, for those of you who may be new to investing or wondered what it means, very briefly and really oversimplifying it, hedging your risk is basically a fancy way of saying that you're protecting your investment by not exposing your capital to the risk of losing it, because you're not deploying all of your capital into one particular investment. Now, again, there's way more to it than that, but we're keeping it very simple so that we can get to today's topic and how it really applies to portfolios and the portfolio's growth. It's no secret we love the markets, both real estate and the stock market. But if you're only involved with we happen to be involved with niches, right, in both of the sectors, the real estate and really kind of notes and options, to be very direct, because of how they lessen our exposure at any one investment and at any one time. And because of that, if something goes awry, for both of them have a fail-safe, if you will, to ease the hit we take if we were in just one investment. So at any one time, we have many assets that not only diversify in both markets, but we're also hedged so that if something goes wrong, it doesn't wipe out all of the hard work that we put into it. But even more important, the capital at risk is smaller too, because it's spread out among the investments. Here's an analogy alert. Say if you had 10 bundles of wood in a fire pit and you have it in a woodshed, right? Now say that a fire starts and it burns down. Now you've lost everything. However, if you spread, say, 2 to 3 bundles around, you still have the 10 bundles. And if there's a tragic event, you don't lose at all. You may only lose a bundle or two. So looking back on your portfolio, have you properly hedged your capital to lessen your risk? So that's it for this edition of Ben's Bits. And as always, thanks for watching, and we'll see you next time.